So, last section here, learning objective 6. We've got several different subjects that we want to talk about. Supplemental wage payments, backup withholding, Form W-9, estimated tax payments, and Form 1040-ES. All right. So, supplemental wage payments. We're talking about here amounts that are outside of the normal payments, so like bonuses or maybe certain commissions, that sort of thing. So there are a couple of ways that employers can calculate the tax on supplemental payments. One is just to withhold at a flat 22%. So that's a pretty high rate to withhold at. So for example, if we have, say we got a bonus of $12,000 that is paid separately, we can withhold at just a flat 22%. This is for federal income taxes, not state. State would be in addition to that. So, what do we have here? So the withholding would be $26.40 for the federal income tax withholding. This should be a rate. So that's one way to do it. The other way to do it is if the supplemental and the regular wages are paid in the same period, then they can be added together and the withholding can be calculated like we did earlier on the total amount, right? So for example, if we had, so we got a $12,000 bonus, if it was combined with our wages for the period, let's say we had $2,000 in wages, now it's as though we had $14,000 of wages and we're going to use either, well, we're probably going to use the percentage method to calculate what our withholding is on this full $14,000, right? So those are the two different ways that that you can do it. And you can only you can use either one if the taxes have already been withheld from the employee's pay. So you can also, if the taxes on this $2,000 have already been withheld, you can calculate this $12,000 as though it's an additional paycheck, right? And just use the regular methods, or you can use the 22%. If the taxes have not been withheld from the employee's pay, then you have to add the two together and calculate it like this, okay? Wages are still subject to Social Security, Medicare, and FUTA taxes, provided that bonus doesn't put them over the Social Security threshold, right? We got Sophia, base salary of $2,000 paid on the first of the month, single, claims no dependents. June, she's paid $2,000 and $93.40 is withheld from her earnings. In July, she receives a commission of $1,000. It was included in her regular wages, so therefore the amount of withholding is going to be based on the full $3,000. Okay, so instead she's got $213.40. Farid is paid a base salary of $2,000 on the first of each month, single, no dependents. Amount of tax withheld is $93.40. He receives a bonus of $1,000. Using method 1B, if you recall up here, 1B, where are we here? The amount of withholding, the amount that would be withholding is, the amount subject to withholding would be $3,000. The amount of withholding on the combined $3,000 is $213.40. The difference between, so you've got to take the difference between those two. So if that $1,000 was paid separately, we still have to calculate it as though it's on the total amount, as though he was paid $3,000. But because he was paid separately on in each of those, like he got his regular salary and he got his bonus separately, then the amount of the regular salary is gonna have that $93.40 taken from it, the normal amount, but the bonus is gonna have the additional $120 taken from it. So you combine them when you're doing the calculation, then when you're figuring out each net paycheck or each net check, you're gonna subtract the regular amount from the regular pay, as though it was just a regular paycheck, and then any difference, that's gonna come from the bonus, okay? Or you can just take the 22%, that's easy, right? Using the information, the employer elects to use a flat rate, 22% on the bonus. In this situation, the amount of withholding would be $220 on that $1,000, okay? And if you recall, you can also gross it up. That's not in this book, but do you guys remember the gross up amount? So you can, if you know that you want the employee to walk home with a certain amount of money in their pocket, so I'm going to give a $1,000 bonus, but I want my employee to have that $1,000. I don't want it to be $1,000 minus all of the taxes. I want it to be $1,000 after all of the taxes. So we got to work backwards to figure out how much is the gross amount of the paycheck. Remember, and the calculation for that was 1 minus our tax rates, the combined tax rates. And our numerator, I think it's the numerator, is what we want our net check to be. I think it's the numerator. So if we want a check of 1,000 and our tax rate, so 22% plus 7.65% for our Social Security and Medicare taxes, so 29.61 minus 29.65, 1,000 by 71.35. This is percent, so we're going to move our decimals over here. So 1,000 divided by 0.7135. $1,401.54 is what the gross amount would have to be. This would have to be the gross paycheck. And then we would calculate our federal income tax withholding of 22% and our Social Security and Medicare tax withholding of 7.65%. Subtract it from that, we should come up with $1,000 for the net paycheck. Okay, I don't think they cover that in this book, but just as a reminder for payroll accounting. So you'd have to, like 22%, 7.65%, and then you double check it. So 308.34. Oh, for 22%, and then 1401.54 times 0.07. Whoops. 107.2. That's not going to come out exactly, but then you make an adjustment to the total amount. So 1401.54. You guys remember this? Is it coming back? Minus 107.22. So it didn't come out right. I don't know why. 22%. Maybe I did the multiplication wrong. Right, 9.6535. I don't think my calculator is helping at all. Whoops. Stop. 7.2. Yeah. 1401.54 times 0.22. 8.34. Did I do this right? 1 minus 29.65. oh. That's right. So this is wrong because I got my percentage. I did my math wrong here. These are going to be wrong too. But if we work it out, it should come out to $1,000. All right. So just a little refresher on all that stuff. Okay, backup withholding. Anybody have any questions on that other? No? Okay. So backup withholding. Employer has to withhold 24% of taxable payments if the payee fails to furnish the employer with a correct taxpayer identification number. So if you are a contractor and either you don't give a taxpayer identification number to the payer or you give the wrong one, then the employer is, or the payer is required to withhold 24%. That's called backup withholding. Also, for interest and dividend payments, if the taxpayer ID number is not given to the payer in those instances, so it's not just wages, then the payee is subject to 24% backup withholding. The reason for this is that, well, it's to encourage people to supply their correct Social Security number in the first place, but also it ensures that the IRS is at least going to get some of the tax from those payments. So these are the circumstances under which a taxpayer would be subject to backup withholding. Now, of course, if you had backup withholding and you filed a tax return, then you get to claim that as a prepayment, right? So it counts toward the amount of taxable your payments made. If the taxpayer does not furnish a taxpayer ID number, if the IRS tells the requester that taxpayer has furnished the incorrect taxpayer ID number, and that's what happens usually, a lot of times, is the IRS will send out a notice to whoever issued the 1099 and will tell them, hey, this is not the right Social Security number or taxpayer ID number. The IRS informs the payee that they're subject to backup withholding due to non-reporting of any interest and dividends on a tax return. So if you fail to report your dividends and interest, then the IRS is going to tell all of your banks that this person is subject to backup withholding. If the payee did not certify to the requester that they are not subject to backup withholding. So this certification usually comes in the form of what's called a Form W-9, which we're going to talk about here. So remember, when you're an employee and you start working, you fill out a W-4 form, right? That W-4 indicates to the employer how much to withhold. A W-9 form is a form that has to be filled out by contractors and issued to whoever is the payer, and it indicates to the payer, one, it gives the name and address and Social Security number or taxpayer ID number that they have to use, and it is a certification of whether or not the payee is subject to backup withholding. Okay, so in that case, essentially it covers the payer, right? It covers them in the case that they have a payee that has not provided the right information. The payer can point at the W-9 form and say, this is what they gave me, right? I'm not going to go through all of that. It only applies, only individuals and partnerships are the only ones that really have to fill out these W-9 forms. And then the payer is going to use this when they prepare the 1099s at the end of the year. They're going to use that to indicate the name, address, taxpayer ID number of the payee. This is what it looks like. So are you an individual? If you're a C Corp or an S Corp, you really don't have to fill this out, but you can if you want, or partnership, trust, or estate. In this case, it's an individual and their name, their social security number, or if it's an EIN. So for example, if it was a partnership, it would be indicated there. And then there's this certification. Under penalty of perjury, I certify that the number on this form is correct. This is my taxpayer ID number. I am not subject to backup withholding. I am a citizen or other U.S. person. And I don't know what the FACTA code is. Foreign factor. I don't know what that means. FACTA. I don't know what that stands for. All right. So again, that W-9 is filled out by individuals who will be receiving a 1099. Chances are, if you go and open up a bank account, you probably have to fill one of those out, because it indicates to the bank that you're not, that's the certification that the bank receives, that you're not subject to backup withholding. Otherwise, they're required to withhold that 24%. All right, estimated payments, estimated taxes. So as we had, I think you've had at least one tax return problem where we've had estimated payments included. Maybe you've had a Tax Act problem as well that had estimated tax payments. Do you guys remember that? I think it was in chapter 6, that Tax Act problem. Maybe it was in chapter 6. I think it must have been chapter 6. Anyway, there was, the timing of estimated payments is important because there are penalties associated with late payment of estimated payments or non-payment of those estimated payments. I can't remember what chapter this was, but I know I had students, and it may not have been in this class, it might have been in the online class, a lot of students that had entered the dates in incorrectly, or they had entered it in as one bulk payment, which generated a penalty within the program because the payment dates were not the correct dates that should have been entered for those estimated payments. Estimated payments are done on a quarterly basis, and generally speaking, individuals who are subject to estimated payments will know, the tax preparer will tell them ahead of time, hey, you've got to make these estimated payments for next year. It's always going to be based on either last year's taxes or the coming year's taxes. There is what's called a safe harbor because, you know, we don't have crystal balls. We can't tell exactly how much we're going to owe in taxes. If I asked each of you right now, what are you going to owe in taxes by April of next year, chances are you're not going to know, right? Because we don't have crystal balls. So these estimated taxes, the safe harbor amount is at least, as long as you pay in at least what you owed last year, combined with withholding and estimated payments. So if you owed $10,000 last year, and I'm not talking about a balance due of $10,000, I mean the tax liability was $10,000, and you have $7,000 withheld from your paycheck, you're going to need to have at least $3,000 more paid during the year in order to avoid any penalties for underpayment. That can be done through estimated payments. Those estimated payments are done 4 times a year. They are done, and they're not, oftentimes they're called quarterly payments, but they're not really quarterly. Because the first one is due April 15th. The second one is due, what is it, June 15th. It's June 15th. The third one Is October 15th, or maybe it's July 15th, sorry. No, it is June 15th. June 15th. The third one is September 15th, and then the fourth one is due January, well, usually it's the 15th, but as you can see here, the 15th must fall on a weekend or a holiday because it's the 17th. Yeah, Shelby.
So I was a little confused on that when it says 90% of the tax shown on the current return.
Mm-hmm.
What does that mean by?
So the safe, it's the lowest. So if this year, it's easiest to write it out. So we would compare. So So for 2022, let's say you had a liability of $10,000, tax liability. And this year, you have a tax liability of, let's say $12,000.
So is that like up to this point in the year, or where do you get the 12? Where do you get the 12,000 from if you don't know like what
you get? So you can take your safe harbor is going to be the lowest of either 100% of this, so you know what that is, or 90% of this.
But how do you know what your tax liability for this year is going to be?
When you prepare your tax return, you will know what this number is. But you're going to pay the whichever is least of these two.
But aren't we needing to pay the like estimated payments in 2023?
Yes. So 100% of this is $10,000. 90% of this is what's 12 times 90%? Minus 1,200 is 88,000. What was it?
10,800.
10,800. Okay. So you don't know what this is yet, right? But you do know what this is. And what you have to pay in estimated payments is the lesser of these two. So you would have had to pay at least this amount. So even though this is 90% of what you owe this year, this covers you for any penalties because you can't know ahead of time.
So then why is that even an option?
Because maybe this is less.
But you don't
So
know.
if you owe this year 8,000 times, what is that? 7, what's 9 times 8?
So like, are you supposed to like make up a number based off of like what
No.
you've paid so far? So then how do you get that amount for 20?
You would have paid in $10,000 because this was your safe harbor. Your actual tax ends up being $7,200, so you're going to get a refund back of your estimated payments. You don't know what it's going to be, but it's going to be. But in order to avoid the penalty, we're not talking about the tax. You always owe the tax. In order to avoid any penalty on that tax that's owed, you have to pay in at least the lesser of these two. And it's based on adjusted gross income. If you paid this in from last year, then you're fine. You met that requirement and you met this requirement.
But why is the second one an option if you can't know what you owe for this year?
Because it gives you the option of a lesser amount. Now, if it so happens that you didn't pay the $10,000 in, that you paid $8,000, you're covered because you paid at least $7,200. Your estimated payments were probably based on this $10,000, which means that with estimated payments, oftentimes people will overpay. I mean, not always, but it's entirely possible that you overpay and then you'll get a refund back. But this will give you, so April, you make these 4 payments of $2,500. So you've paid in $10,000. You do your taxes and you determine that you really only had to pay in $7,200. Well, okay, so you overpaid. You're going to get it back. But if you made 4 payments of $2,500 and it turns out that you owe $2,000, your safe harbor would have been this $10,800, but you are still covered because you paid the $10,000. So you don't have to pay any penalty. Now, you're still going to have to pay the additional $2,000 in tax because you owe $12,000 and you only paid $10,000, but you won't have any penalty on it. The 90% is so that if you didn't pay that $10,000, then you would have some cushion to avoid any penalty.
So the only time you do that is like if you couldn't pay the full 100% from last year, and so you just paid what you could.
Yeah, and there are people that will do, like they'll maybe skip a payment. They probably shouldn't, but it covers them. So it's just the lesser of either of those two, and it depends on AGI, as you notice. So that if your AGI is over 150,000. Then these percentages become 110% and 100%. Again, this is the minimum that you had to pay in order to avoid a penalty. You still owe the tax. Let's see if they've got an example here. No, this is just a kind of a generic example. Let's see.
And this would be for like anybody that's self-employed would have to make those estimated payments?
Yes, and oftentimes anybody who, and you don't have to be self-employed, anybody can make estimated payments. Oftentimes retirees will make estimated payments. Any type of income where you don't have withholding from it, if you think it's going to cause you to owe tax. But there are certain people that are required to make those payments. So, for example, here, if it was the 10,000 and the 90,000, if you only made, actually, no, we'll do that. If you only made $8,000 in payments, now you have underpaid. If your payments every quarter were $2,000, or every estimated payment was $2,000, now you have underpaid because you don't meet that safe harbor and you don't meet this safe harbor.
So you get penalties for not paying throughout the year, even if you like pay it all at the end of the year when you file your taxes?
Yes. They want their money and they want it now. Yes. If you're self-employed and if you owe tax. Now, if it turns out you didn't owe any tax, then you didn't have to make any estimates. But the safe harbor is based on what you know what you paid last year, versus what you don't know, what you're going to owe this year, whichever is less of those two is your safe harbor.
Are the estimated payments submitted the same way that like the payroll payments are? Or since it's like an individual versus an employer, can they just like send in a check, or is it like online? Or?
Yes, so either way. So you can send in, I don't know if they have do they have a picture of an estimated voucher? Yeah. So this is what a voucher would look like. It can be mailed in. Has to be mailed by the deadline date. It has to be postmarked by the deadline date. I would always tell clients, if you're not sending it certified, make sure you make a copy after it's been postmarked so that you know, or take a picture of it so that you can prove that it was posted by the due date. Because that's another way that they will penalize you, even if you pay enough. If you didn't pay it on time by the due date, you'll get a penalty for it. But the amount here, which would have been calculated by the tax preparer the previous year, and it could be adjusted. You could decide, okay, so this is how much, this is the minimum amount that I have to pay to avoid penalties. I know that. As long as I pay this, I'm not going to have any penalties. However, I also know that I made a lot more money this year, and I'm going to owe a bunch of money. So I want to add some to this.
So when they file taxes for 23, whoever prepares the taxes would give them new like vouchers for the next year to use?
Yep, and that is a big part of the job of the tax preparer, is not only to look retroactively at what has happened in the last year, but to help the client plan ahead for the next year as well, and to give them the information that they need in order to try to avoid penalties. Because what happens if you don't do that and they end up owing and then they've got penalties, and they come back to the tax preparer and they're like, what? You didn't tell me that this was going to be the case. Right? It's always, this time of year is very busy for tax preparers in making sure that those estimates were correct. as well. So if a client had unexpected income during the year, so we would go and do we would make a preliminary tax return to see what we think their taxes are and what they have already paid, and we might have to make it up with an additional estimated payment. Now, as long as we had them make payments that were at least 100% of what they owed last year, or 110% if their AGI is over 150,000, they're safe from penalties.
Are the penalties listed anywhere in the chapter? Because I didn't see them really talk about anything for like not paying. They had discussed the penalties for like if you don't have your like tax ID number listed, but I didn't see anything about like not paying.
I think they're in one of the other chapters. I can't remember which one. One of the ones we've already done.
Okay.
Are the penalties. So, and there, yeah, there's all kinds of penalties. Like I said, there's penalties for late payment of estimates, for not paying estimates, if you shouldn't have paid estimates, for, what's that? Pretty much. And then they tack on interest when you're late paying those penalties as well. Now, there's another safe harbor in that if you owe less than $1,000, there's not going to be a penalty. As long as, so again, as long as they paid at least 90% of what's currently owed and 100% of the tax shown on the last year. If AGI is under 150 or 75,000, if it's over that amount, then like I said, these percentages then become 110 and 100. So when you're doing that, when you are making those estimates, what you're doing, your starting point is this. This is your starting point. Calculating what that estimate would be based on 100 or 110% of their liability this year. But then you would ask them questions about, well, do you anticipate anything else happening this year? Do you anticipate getting any more money? Which sometimes they do. You know, sometimes that's the, oh yeah, I'm gonna, you know, I'm gonna sell my boat. I don't know, and I'm gonna sell some land, and I'm gonna get a bunch of income, investment land. I'm gonna have this capital gain. So yeah, I'm gonna have more income. And oftentimes what we would also do, especially with higher income taxpayers, is we would work closely with their brokers, like their investment advisors, and talk to them about, you know, where are they so far this year? What does it look like you know, what do you think their capital gains are gonna be? What do you think their dividends are looking like? Because the brokers have that information at least year to date. So there are a lot of different factors to take into account. And the thing is, the people who need this the most also happen to be the people who are willing to pay for the service of doing that, right? So those are the safe harbors. Does that help, Shelby?
Yeah.
Okay. Any other questions? So we went through, I think that's it. Those estimated payments, backup withholding, and all that. That's it for the chapter. Any questions? Shelby says, yes, I do. Oh, no, don't. Yeah.